So this is where I find like the current banking model to be sort of like weird and maybe obsolete and definitely not what consumers expect. So for example, if you go to a bank and you put your money in a deposit account and then they loan it out to make mortgages, do you realize that you're an investor in those mortgages as the depositor? I don't think you do. I mean,
no, because what they do is they take those mortgages, Sachs, they package them up, they sell them, and they get an origination fee and they get the money back.
Not always. They're not
but not always. But maybe they should be. Maybe like they should have to.
B of A, Wells Fargo do not. Exactly. So B of A, Wells Fargo, for example, they do a lot of that. But if you look at First Republic, they have a $90 billion loan portfolio on their balance sheet that they've not packaged up and sold. So the packaging and selling of mortgages generated the liquidity that the banks needed, but there's a cost to that. So a lot of banks will try and balance out their loan portfolio where they'll package some of it up and sell it. But when they do that, they take a loss. They pay a fee.
Maybe they should be required to do that because because I mean, look, to the point about mark-to-market assets, it's very hard to mark an asset to market unless it's liquid and publicly traded.
Let me give you an economic point. I think that there's about $7 trillion in deposits in banks. So if what you guys are saying happened, you're basically sucking $7 trillion out of the system that's being used to fuel purchasing in the form of loans. And you're taking that, or call it a 10% discount to that. So call it $6 trillion. And you're saying, we got to go find a market for $6 trillion of loans. And then we're going to have $6 trillion of cash sitting in a bank account doing nothing. And that challenges the way
that cash would go into money market funds. So in other words, like you'd package up all those mortgage bonds, you create a mortgage bond security. And then if depositors want that product, they'll just buy it. They'll just buy the ticker symbol.
Yeah, but what is a money market? It ends up being the same thing where money is, you earn interest on cash that's being used to make investments elsewhere. So ultimately, if you want to earn interest on your cash, it has to be loaned out somewhere to someone.
I understand, but what I'm saying is, look, I'm just brainstorming here. I don't have the answer.
But spitballing. Yeah.
Yes, exactly. I'm not saying this is what should be done. I'm just kind of asking whether it might make more sense. What if on the depositor side, all of the things you put your money in are money market funds? And then when the bank goes out and does its lending business, it does ultimately at some point have to package those up and they get turned into securities, you know?
But money market funds, you know where that cash goes? So when you invest in a money market fund, you're giving that money to someone who's using it to make a loan. Like it is also...
I understand, but then the depositor would never be at risk.
But it would be mark to market is Sachs's point.
The depositor would never be at risk. It would never be a risk of bank failure.
I just want to give...
You're shifting the risk equation to the fund manager or the money market instead of the manager of the bank. And at the end of the day, that money has to be loaned out by someone.
Just the owner of that security, that money market fund, that would take the hit.
Okay, just as we wrap here, because I want to talk on some other issues as well, there's two things that are super tangible that founders can do right now, or people who want to mitigate against these kind of issues. There's something called ICS, Insured Cash Sweeps. These are accounts that automatically, will put your money into multiple FDI insured institutions, $250K at a time. We talked about this previously. There's a bunch of folks doing that in fintech. I won't give any of them free plugs here, but you can just go look and search for ICS. There is also maybe some thought here that the FDIC $250K limit, maybe that's outdated. Certainly for businesses it is. So maybe that should double or triple. And obviously that cost would be spread out. And then finally, you can go to treasurydirect.gov right now and buy short-term government debt. And I literally have startups doing this who have major treasuries. They're going there and buying short duration stuff themselves, holding it themselves. So they don't have to worry. This is provided by the government, is my understanding, and people are buying direct from the government.
I personally am not a fan of startups buying T-bills because of the duration mismatch problem. They always underestimate when they're going to need their cash, and so I don't like tying up cash.
This is if you had a
bonds.
Giant treasury. Yeah, I agree with you. But this is for giant treasuries at a small point. They always get it wrong.
I see this all the time. Whenever they try to, let me just say, when startups try to create laddered bond portfolios, they end up needing the money sooner than they thought. What I'd much rather see a startup do is buy 100% US T-bill backed money market fund run by the absolute biggest of the big financial institutions, because you can get in and out of it at any time you want and without paying a fee. And that's so much better than trying to manage your own bond portfolio. Let a professional fund manager do it.
Well, there are people who do provide these kind of bond ladders. I'm just telling you what the best practice advice going around is. Why don't you just buy a ticker symbol
through like a brokerage account?
Sure. Or multiple ones, right? But now this is, I think, speaks to Chamath. the fact that we have startup founders and people having to manage a treasury this granularly, is this a failure or is this what should be happening? Should we have to have treasuries in the $10 million or $20 million range be this granularly managed, or should this just be FDIC rates, should be just a 10x?
Well, in the absence of regulatory changes that protect this money, you need to have a financially sophisticated actor on the board. And again, I go back to that should be your venture capitalist. And that person should not have conflicts of interest with the banks that they direct you to. I mean, I don't think that that's a very controversial statement.